Welcome to TheoTRADE. This is Don Kaufman. It's November 29th, 2023. Just a few minutes after the cash close here on this Wednesday afternoon with the S&P futures massively unchanged. In fact, that's what the marketplace has been doing, well, the entire week. Nevertheless, there is a ton of economic data coming out. Not only did we have some today, but we have some throughout the remainder of the week. It's got us asking the question, is an economic slowdown bullish for markets? Now, think about that, because some of the data that has come out in, recent days, it's been a mixed bag of goods. Some data is pretty good. And again, we're looking at economic data, everything from obviously CPI, which has actually slowed to some degree. But then you got to look at like GDP from today, which was hot, but it was also government spending that was hot. There's more economic data coming out. But I got to tell you something right off the bat. When I'm talking about, an economic slowdown, push aside all of the data for just a second. Push aside what you think about the S&Ps. It's all about Fed right now, and it's all about interest rates, right? So if I jump over to take a quick glance at what we term the CME group, this is the Fed Watch tool. There is an aspect over here that begs to be looked at, and maybe some of you look at this on a day-to-day basis, some of you don't. This one is fairly shocking, and of course, this will be the talk of the trading community for the days and really the weeks to come, basically to the end of the year. What you're looking at here is the March, okay? And again, this is March 20th of 2024, right? It's the March 20th, and what that basically denotes is there's a Fed meeting on March 20th of 24, which is basically you're looking at like the end of a first quarter. And this is the present target rate, just 525, 550. Oh, here's the real kicker. Okay. The real kicker is this. They're pricing in a 50-50 shot right now for a rate cut in Q1. And to get that, you have to understand, like the Fed just keeps saying higher for longer, higher for longer. The market, it's not listening. The market's actually turning around and going, no, economic slowdown is imminent. And this is where you really have to start to question, like, the market and the rally right now. And look, the entire rally, let's just cut to the chase. The entire rally in this market, and I'll jump back to this in just a moment, but the entire rally inside of this marketplace, let's cruise over to the spiders. When I'm talking about the rally, I'm talking about this. I'm talking about the entire year. 100%, okay, of the returns this year in S&Ps. In fact, let's go to year-to-date percentage. Basically, let's just round up the spiders this year, which is represents, of course, S&P 500. Spiders are up roughly, let's just call it what it is, 20% a year-to-date basis. 100% of those returns have actually come from none other than, you guessed it, the Magnificent Seven. There's nothing else that's actually really producing returns. Yeah, you can look at the financials. They're up 3.4%. Okay, but some of the financials, ironically, are getting rocked a little bit out there. There's really only one financial that's performing extremely well. It's JP Morgan. You look at like Bank of America, ooh, it's down almost 10%. You look at something like Citi, massively unchanged. Wells Fargo, ooh, that's a positive one. It's up almost 5%. But the point that I'm trying to make is you're looking at markets right now, and it has been unquestionably this magnificent move back to the upside. Forget about even like year to date. Again, just a few weeks ago, you're sitting with like, wow, the market's going to finish higher or lower in the year. Also, we burst to the upside. If you're looking for a Santa Claus rally, you got one already. Okay. To the end of the year, though, now, to me, is really questionable. And it's because all of a sudden you're looking at this idea of an economic slowdown. And as I said, you almost have to push the data aside. Yeah, the data is going to move markets. Unquestionably. Like you're in this huge catch-22. There's going to be good data. You're like, yeah, that's good for markets. But wait, maybe good data isn't good for markets because then the Fed might not cut rates. But let me actually deviate right back, okay, to, well, this. By March, okay, there's a 50-50 shot right now, basically, that they're going to cut rates. And the reason I'm bringing this up, if this is is true, and this is relative, this is 48% probability of a rate cut. And by the way, there's even a 2% chance of like a 50 basis point cut, which is just huge. You realize how bad things would have to be. The economy has to fall off the side of a cliff. It's actually one of the quotes from Bill Ackman in the last 48 hours. He was talking about, the Fed and the possibility of them cutting rates in Q1. Everybody picked up on that, but nobody picked up on the point that he said, well, but the economy, they would have to cut rates to stop the economy from falling off the edge of a cliff. In my opinion, the economy would have to fall off the edge of a cliff for Fed to actually cut. And what's crazy right now, and again, I'm not trying to read tea leaves, I'm just telling you, a rate cut in March, okay, horrible things would have to happen, not just to the economy, but the market. And there is absolutely unequivocally a disconnect right now on that particular front, where you're like, yeah, the economy sucks, let's rally. Think about that for a second. But at the exact same time, with all due respect, the only thing that matters is the Magnificent Seven. That's it. That's where your returns are being generated from. So, as I said, there's kind of a disconnect, and you're caught in this really weird place where some people call it like Goldilocks, but Goldilocks is the idea like low rates, everybody's going to be happy, we'll just kind of, cruise through everything. But in this particular case, we're still in a very high rate environment, and performance in individual sectors is terrible. It's nothing but tech. And that's why I say it's this wicked catch-22. What I don't like about the markets right now, and again, I don't want to give you a big story about being bullish or bearish. People know where basically my positions rest. Look, I'm negative, aggregate of about 3,000 spider deltas, which is not, by the way, that's not good in the midst of a rally. I'm negative about 3,000 spider deltas. What I don't like about markets right here, right now, okay, I would cite to you risk reward. If you're bullish right now, I'm okay with that. Like, it's fine. Like, it's going to be another, rally into the end of the year. I'm fine with that, okay? But you have to look at risk reward. If you're going to be bullish right now, use defined risk. Use spreads and so forth. If we're going to pop to the upside, hey, wonderful, okay, spectacular. But when I cite risk reward, what I basically, am implying by that, is there upside potential? The answer is yes, unequivocally there's upside potential. But I think at this point that the downside risks way outstrip the upside potential. And I'm not saying that, solely on the fact that we've had this magnificent rally already. I'm saying it because the implications and the idea of a rate cut is that an economic slowdown can't possibly be bullish for markets, because you got bullish markets, they're going to cut rates into bullish markets. It's all wrong. It's all wrong. And, moreover, the bonds clearly see something. I mean, take a look. We'll go specific to the TLT. That's a ripping rally back in the TLT. In fact, the TLT is now only down about 8.7%. Meanwhile, though, the bonds have been in the middle of a crash. We don't know yet if this is a bear market rally. That's something I actually brought into question literally in the weekend update. I'm a believer that there could be one last hurrah of the bonds trading to the downside, where there's a little panic at the disco out there. Nevertheless, it's a lot on your plate, but think about risk reward. If you're going to be bullish right now, that's fine. Define your risk, in those particular trades. All right. One of the last points I want to make, is I do each and every Wednesday, I want to look at expected move, because what you've basically had throughout the course of, the beginning of this week, and that's Monday, Tuesday, Wednesday. This is where people start talking about, well, it's kind of holiday trade. No, today, man, the S&Ps woke up today. They woke up. Take a look at the volume inside of the S&P futures. They did 1.5 million contracts. Okay, just want to make a quick point. No, it's rocking out there again today. So that is kind of a moot point. So be aware the remainder of this week, which is just Thursday and Friday. Okay, expect the S&Ps to be moving, because quite frankly, we've done basically nothing. And we are sitting on a week that you're only expecting. Again, we're only expecting this $46 move this week. And right now, we're basically down just mildly. Look, okay. It's a big tech world, and I say this all the time now. It's a big tech world, and we are all just living in it. That needs to be your only focus between now and the end of this year. What big tech does, so goes the markets. Thanks everybody for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.